Good day, everyone. My name is Tom Sweet. I'm the product manager of ABB's North American Power Reference Case, and our team is responsible for producing the reference case as well as any consulting around it, and that includes asset valuations, any market analysis, or custom scenarios. Before we get into the talk, I'm going to have our standard disclaimer. Basically, the information in this presentation is subject to change, and that ABB is not liable for any damages arising from the use of this information. I want to bring up a little bit of the, energy market intelligence. Again, we're now part of ABB. And want to talk a little bit about, why are we rebranding from Ventyx to ABB? Again, there's some, software, number one is very key to ABB's strategy. So again, that was part of the reason for acquiring us. But the actual rebranding, this actually completes the integration of Ventyx into ABB, which started back in 2010. And as a brand, the name Ventyx has been retired. So again, we're now ABB. A little bit about ABB. Again, it's a large multinational company. We have over 145,000 employees. About $42 billion in revenue in over 100 countries, and ABB itself was formed back in '88 with the merger of the Brown Boveri Corporation and the Swedish ASEA company. But again, both those predecessor companies have been around for well over 100 years. Where we fit in ABB, well, ABB is organized into 5 main areas. We're in the Power Systems Group. Again, it's roughly 20% of ABB. And again, EPM, which is what Advisors is part of. We have about 250 employees. A little bit of history. Again, we go back to about '75, where we introduced our first commercial optimization software. We manage a little over 1.4 terawatts of capacity and support over $5 billion of investment decisions. A little bit about our footprint. You hear a lot of acronyms thrown out: EPM, EMI, Advisors. We're all part of the same group. EPM is Energy Portfolio Management. That's that big 250-person group. It's made up of really 3 pieces. We have an advisory service. We have a reports and data services where Reference Case and Velocity Suite reside, as well as simulation-ready data. And then we have the software arm. Now, this gray bar here, or this gray box, if you look at advisory services and our reports and data, that's what we refer to also as energy market intelligence. So it's a subset of EPM, which is everything but software. Yeah, going to get into the agenda. Before I get into the agenda in much more detail, I want to mention that you can use the chat window to ask any questions, and we will respond to them either in line or after the call. So today we're going to talk a little bit about the reference case, talk about how we produce it, and then get into the fundamental drivers of electric prices. So we're going to talk about the demand picture, the supply picture. We'll then have Kathy Jones talk about renewables and what's happening on the environmental scene. We'll have Garrick Hoops talk about the gas and coal forecasts. And then I'll talk about the actual schedule for producing the reference case, a little bit about the product itself, and then if we have some time left over, we'll address some questions. So going into the methodology, the big question is, what is the reference case? Well, really it's a 25-year long-term forecast of the North American energy markets. And, it's fundamental in nature, so we look at, the interaction between, fuel supply and demand. We consider various environmental regulations, all the various thermal resources that are on the ground, any new items that might be in the pipeline, any units that might get retired, and, pull this information together and create an electricity price forecast. Now, we're also independent and unconflicted. We're used by a variety of different market participants, owners of assets, sellers of assets, people who are acquiring assets, and they, look to us to provide this independent view of the marketplace. And finally, we use ABB's market-leading software from our ProMod model, which has been around well over 40 years, to our intelligence product with Velocity Suite. Let's talk a little bit about our methodology on how we produce our reference case. Well, it starts out with a data. As you can imagine, for any fundamental model, there is a tremendous amount of data that's required to produce our forecast. So from Velocity Suite, we get information on loads, the generating characteristics across North America, information on gas and coal supply, from both Velocity Suite as well as other sources. Information about the transmission, non-power, supply curves, et cetera. So a lot of information is pulled. That all feeds into our integrated model. Now, what happens in the integrated model, we use that for developing, capacity additions, any retirements, any retrofits, producing capacity prices for electricity, fuel costs, emissions, and RECs. And the nice thing about the integrated model is that all of these output assumptions are consistent. So as, for example, in the case of environmental regulations where you might be retiring a lot of coal-fired resources, again, that lower demand on coal with our interaction with our coal model results in lower coal prices, which of course, feeds back into the electric energy prices. Of course, and with the retirement of the coal, that affects the amount of capacity that is being built, which has the impact on the energy price. But again, also with the retirement of coal, you're going to be building gas in place of that, and our gas model responds to that changing demand with the upward pressure on gas. Again, you would have a slightly higher natural gas forecast. So the integrated model allows us to, again, have a variety of consistent assumptions under, again, just about any type of scenario that we can model. Now, finally, these information on, unit builds and fuel prices gets fed into the our ProMod engine to develop our final electricity price forecast. So now let's talk about, some of the fundamental drivers. So we'll start with demand. Now, one thing about demand is that, we're seeing it is continually declining over the years. What we're showing here is what we were forecasting for demand back in spring 2008. Again, pretty much, kind of at the beginning of the recession. And all the way through spring of 16. A couple things we notice is that, number one, the magnitude is slightly declining, but more importantly, the growth rate is declining. Back in the spring of '08, you know, the growth rate here was probably about 1.5% a year, and right now we're down around 0.8%. So not quite half of the growth rate, but again, it is declining. And some of the big drivers of this are the impacts of demand response, distributed generation, and energy efficiency. With all those items, I want to mention, you know, our forecast is based on, it's a wholesale energy forecast, so we're looking at, you know, wholesale load. So any generation behind the fence through, you know, rooftop solar or, you know, energy efficiency, those don't actually, you know, we don't see that in our forecast. The way we see that is through the reduction in demand. Now, going into some of the details of the energy efficiency, we're looking at a couple different time slices here. You know, what we're forecasting in 2016, and then in 2021 and 2026. And we're breaking this out by the different NERC regions, just to show the increasing impact on energy efficiency as we move through time. So with that overview of demand, again, key takeaways there, you know, the magnitude, of course, is declining, and, you know, the growth rate is declining. So now let's look at supply. And what we're showing here is a view of unit retirements through the end of last year. And what we're seeing is the coal retirements over time. They're definitely increasing the amount of coal units that have retired. That's in response to a couple of factors. Number one is increasing environmental regulations, but also with the shale revolution, with low-cost gas being available, that is put a lot of pressure on older, less efficient coal plants, and you know, that is helping to contribute to the retirements. Flip side of retirements is what resources are being built. Again, in the early part of the 2000s, we had a big buildup of natural gas resources, really to kind of compensate for, I guess, a lack of construction in the 90s, and also in response to some extremely high market prices. And then as that supply built out, of course, we then started having lower load growth. So the builds kind of in this final period have been in response to, again, the units being retired primarily. Another aspect you want to point out here is that on the renewable slide, we have seen quite a bit of increase in the amount of renewables being built. And in fact, we're, for the past 5 or 6 years, the amount of renewables built have exceeded all other resources, including gas-fired resources. Okay, with that, I will have Kathy Jones will now talk about, we'll talk in more detail about the renewable build-outs.
Thank you, Tom. Good afternoon/morning, everyone. As Tom said, I'm Kathy Jones. I'm the lead for our renewable and environmental practice. Just want to give you an overview of what we're seeing in those particular markets today. So what we're looking at here is a graphic that shows you the level of renewables by the ISO/assessment areas. So what you can see is that California really has outpaced ERCOT, but ERCOT's mix is generally, definitely just mostly wind versus California, Mexico with the high solar concentration. But what you also see is that within the MISO region, we're seeing that there's a lot of biomass, as well as in Florida, being targeted with a lot of biomass. And you think of Florida as the Sunshine State, but it really has a pretty low percentage of solar installation. Whereas we're looking at CERC, where that really just kind of varies depending upon what region in CERC you're in. So within CERC, there's like the CERC East region has a high solar concentration, but then other parts of CERC have higher biomass concentrations. So this actually then leads to, you know, just the higher concentration of these renewables, and also this is just utility scale installations. This isn't reflecting any of the rooftop solar that you see in these regions. So for instance, in the Northeast and New York, you're going to have higher concentrations, as well as in California with the duck curve, you've got the higher concentrations of rooftop renewables. This gives you an idea of what the pipeline has looked like for the wind capacity, and we're looking at it on a by-quarter basis. So the gray bars, you can see generally there's always an uptick in that fourth quarter, and that's associated with the uncertainty over whether the PTC would be extended. And in 2015, you could see how that really reversed. But of course, in the end of 2015, we did have the extension of the PTC. So the PTC and the ITC have been restored with some level of certainty through the 2020 timeframe. So you can see that with the change in the pattern on the wind installations, where you're seeing a lot of that coming in the first quarter of 2020 versus the fourth quarter, as you see that huge uptick in 2016. A lot of that uptick in 2016 is really what we're seeing there is there's about 2.6 gigawatts that are under construction in 2016 in that fourth quarter, and 15 gigawatts of that is just in the proposed phase. So a lot of those may have been introduced in 2015 in an attempt to get it under construction and to qualify for the PTC before it was extended. So our spring reference case is going to reflect the extension of the PTC and the ITC. So now we want to look at it in comparison to solar installations in the pipeline. You can see that in the 2016 timeframe, you really have the most amount of solar and wind pipeline, where you've got 40 gigawatts of wind and 29 gigawatts of solar. And then that's dropping down. And this is as of yesterday as to what we had in the pipeline in our Velocity Suite product. The total installations for 2015 were 15 gigawatts compared to 57 gigawatts for the wind. So 2016 is on record to be, you know, a very high wind penetration year if all of these installations go into service. But you can see how that pipeline still continues to drop off, but you may see that pipeline increase due to the PTC and the ITC extensions. So I wanted to do some research into what other firms and organizations are looking at as far as the impact of the solar and ITC extension, as well as the wind extension. So what you see here is the graphic on the left is the level of solar installations that were expected before the ITC was extended. And this is from Greentech Media. And then what you see on the right is the expectation after the ITC extension. So really this is resulting in an uptick of about 25 gigawatts of additional solar by the 2020 timeframe, with the majority of that, as you can see in the bottom bar here, that's the dark blue, as you see in the light blue bar, that's the utility scale solar. So that's where the majority of the expectation is that the utility scale and residential scales are going to be the most opportunities for solar installations after the ITC extension. And I didn't want to limit it to just Greentech Media, so we've got NREL assumptions as far as what they were seeing the impact of the ITC-PTC extension. So what you're looking at on the left are the solar capacity, and what you're seeing on the right is the wind capacity. But what you notice is that the solid red line versus the dotted red line. Let's just leave low gas out of the picture in the equation here. What you see in that solid red line was with the extension. So on the solar, you don't see that NREL is assuming as much of an uptick in the solar installations compared to the uptick in the wind installations that you see on the right. But you can also see that by the 2030 time frame, the expectation is that that uptick is only going to last through that PTC extension and then start to taper off to the same levels pretty much as the no PTC extension. So in that regard, our spring reference case is going to reflect that uptick. It may or may not be as high as Greentech. It may or may not be as high as NREL for the wind, but we will be reflecting additional installations related to those extensions. And then just to give you an idea of, states that have RPS requirements, as well as whether they are on target for meeting those RPS requirements. What you see in white are those states that do not have an RPS requirement versus those states that in the lightest blue that are not meeting their current RPS requirements. So the major takeaway here is that, with the decline cost of the solar and with the ITC-PTC incentives, we are seeing that the majority of states are on target, and this is just their current targets for meeting their RPS requirements. There's a question, where's the unit retirement schedule after 2016? You will see that in a slide that I have in my environmental assumptions, and it just addresses the coal retirement. Moving on to something that's due to the low natural gas prices, as well as changes that have been coming up as far as all those states having met their RPS requirements. So what we're looking at here is a graphic that shows you the amounts of energy generation legislation that was enacted in 2015. So I'm just going to focus in on this pie chart here, which is just for renewable portfolio standards. So what you see is that there were 8 bills that were passed to modify, as well as 3 bills to roll back. Of those 3 bills, it was, Kansas froze their RPS requirement because they'd already met it. West Virginia repealed their RPS requirement, but you have the increased bills of 4, which you've got California, Connecticut, and Hawaii was included in this, that have passed bills to increase their RPS requirement. And then since this particular 2015 graphic was produced, we also have Oregon, who has slated that they're going to change their RPS requirement to 50%. You also have, as Tom mentioned, the net metering. So you've got 9 bills that were introduced for net metering. Net metering is becoming a very hot topic as it relates to solar because a lot of the fixed charge components, a lot of the PUCs as well as the IOUs are trying to increase that fixed cost requirement for the net metering. So there's going to be probably continual activity in regard to this. In addition, so this was U.S. In addition to this, Alberta has also passed an RPS requirement for 30% RPS by 2030 and has hinted to the fact that there may be a possible RPS capacity auction that they are slated to introduce in the 4th quarter of 2016. We'll reflect the 30% RPS requirement in the reference case, but as far as the capacity auction, we will not be addressing that until that all really gets ironed out. And this just gives you a flavor for what we built in our fall reference case. We have not we have not completed the spring as far as that goes. But this gives you an idea that just with state RPS requirements versus a national RPS requirement, that by the end of the forecast period, we're looking at 9% renewable generation as a percent of total retail sales, with the majority of that coming from the wind and biomass and solar. But you can also see the increasing level of solar throughout the forecast period, whereas the wind reaches a certain level and then it's basically growing based on the energy growth. So as Tom mentioned, with the lower energy, we're also going to, that then if you just target RPS requirements, that would then institute lower RPS requirements as well. So there's some back and forth play that go on there in the forecast period. Moving on to the environmental picture. So, of course, EPA has been in the news a lot, particularly for the energy industry, but I just wanted to point out the three major components or regulations that they have been addressing. So with the Cross-State Air Pollution Rule, or CSAPR, they've revised their NOx footprint on that. They've also extended the time frame as far as compliance periods. So for CSAPR, originally the compliance periods were 2014 and 2017, and those have been extended now to 2015 to 2018. But they also have revised budgets, and it's slated, they made their announcement in November on their new proposed rule. So, and that's really for the NOx. And then they published the final rule March 14th in the Federal Register. So once it hits the Federal Register, then it's there. So all of the back and forth between CSAPR may have finally come to an end, but it's still open for comment. For the mercury or MATS rules, they have revised their cost projections, or the D.C. Circuit Court asked them to go back and revise their cost projections. They have not released those revised cost projections. It was open for comments, and they held the hearing in December, but just as of March 3rd, the D.C. Circuit Court was supposed to have that hearing, but Judge Roberts made the decision in March 3rd without a written order that would that would override the stay on mercury, so on the MATS rule. So therefore, based on that, we see that MATS really is going to stay in place, but I don't think there's a major impact there because most of the retirements and or retrofits associated with the MATS rule have already occurred. The big item that's on the plate now is the Clean Power Plan. We did, for our fall reference case, a math-based national compliance and reflecting building blocks. We also did one with carbon. But for the Clean Power Plan, the Clean Power Plan was stayed, and so by the Supreme Court, so that kind of has led to, people backing off as far as trying to do their state implementation plan. But and I'll discuss that a little further later on. And just to address the modifications that were made for CSAPR, you can see that these are now the 23 NOx ozone states. The removal, South Carolina and Florida were removed from the CSAPR NOx, but so there won't be much impact there. And so the NOx emissions are going to actually be a little more stringent, so we might see some uplift in NOx energy prices, NOx allowance prices. And this just gives you an idea of where the SO2 emissions have been historically, but what I want to focus in on is the 2015 through 2018 time frame, where you're looking at the, the historical emissions are actually on target for the Group 1 and Group 2, SO2 emission budgets. So that's going to actually apply downward pressure on your SO2 emission allowance prices. And just to give you an idea of what that looks like, so back in 2011 when CSAPR was introduced, you're seeing very high emission allowance bids. But just focusing in on the smaller graphic here and looking at what has happened since January 2015 when things were actually reintroduced for CSAPR, you can see that the prices, jumped back up to about $250 per ton and then continued to decline as the uncertainty over whether CSAPR was going to make it through. But November 15, when EPA released their new proposed CSAPR ruling, you can see that the Group 1 and Group 2 SOx emission prices, which are these lines here, actually kind of bottomed out. So we're not seeing a lot of trading on the SOx as well as those prices bottoming out. But then when you have the new rule for the NOx emissions that was introduced, you can see the uptick in the seasonal NOx prices since they announced that new proposed rule. So that's actually providing some uplift in those NOx prices because of those more stringent requirements. So you asked a question about the coal retirements. So this gives you a flavor for what the coal retirements are by the ISOs, and you can see the major uptick in 2015, and that's mainly driven from the MATS retirements. You might still have some of the MATS retirements in 2016, but what you see here is that by looking at just focusing in on PJM and the Southeast, that would be the gray bars and the blue bars. So when you focus in on PJM and the Southeast, really they constitute the majority of the coal retirements, more so than you see in the SPP and MISO regions. So there's more at risk as far as retirements go, and these are only announced retirements. So this gives you a flavor for how those announced retirements start to taper off and dwindle through the 2024 time frame. So we mentioned the Clean Power Plan, and EPA introduced the 3 building blocks for the Clean Power Plan, one being coal efficiency improvement, where they targeted different levels for the different regions, and that was based on looking at the actual historical coal efficiency improvements that have been seen in the 2012 through 2010 time frame. It also reflects a 75% capacity factor on combined cycle units based on their summer capacity, as well as a large uplift in renewable energy in the resource mix to over 28%. So with the CPP on hold, those building blocks, you may still see them, but it may not provide as much long-term incentive for making these modifications if the stay stays in place for an extended period of time. But in speaking to the stay, this gives you an idea of the time frame. So the Clean Power Plan was announced in August. You can see states must submit their initial state implementation plans in September 6, 2016. But with the stay, EPA has indicated, they haven't made it final yet, but EPA has indicated that they may extend the state implementation plans, but that they would not revise the time frame for when the compliance periods begin. So they would probably still stick with the 2022 time frame, but may give states more time to submit their extensions. So by doing that, that then helps them, of course, with the legal challenges regarding meeting those time frames for submittal. But how are the states reacting to the EPA Clean Power Plan stay? This is produced by the Power Plan Hub. So what you're seeing in blue are the states who are continuing to plan, as well as in the red are those states that have suspended planning. And this was as of yesterday. I had pulled this graphic in February, And so it continues to change. You still have a number of states that are dropping off the continued plan and increasing on the suspension of planning. And then you also have the 9 states here that are also assessing whether they will continue to plan and file their state implementation plan. So keep in mind, excuse me, keep in mind in this graphic where you see the red and where you see the blue, because that will play out in the next graphic where we show the reductions requirement by state. So the lighter colors here represent those states that are less than the 32% total overall reduction that EPA is targeting. And then the darker the states, those are the states that have have higher requirements. So as you can see, those states in the light blue line up with the states here in the blue, where the states in the dark blue line up with the states in the red. So based on that, you could say, the major takeaway there is that those states that have the highest requirements are the ones that have actually suspended their planning based on the state. I'd now like to turn it over to Garrick Hoops to speak with you on our fuel forecast. Thank you.
Thank you, Kathy. As Kathy said, my name is Garrick Hoops, and I lead the fuel forecasting process for the reference case. I'm going to give a quick overview of natural gas and coal, and look at some of what's happening in the market, as well as a few thoughts about how our forecasts are going to be impacted for the spring release. So starting off talking about gas inventories as well as prices, where are they? So this chart we're looking at here shows working inventories of U.S. natural gas through March 6th and highlights the range and the average, which is the dark blue line. The falling gray line there is the Henry Hub price, and it corresponds to the right-hand axis. Since the beginning of summer, gas storage has been pulling away from the 5-year average, and predictably, as production has continued to increase and the mild summer weather tempered demand from the power sector, prices fell from the $2.80 level or so to near $2. Prices continue to fall with the mild early winter, which minimized storage withdrawals through a short burst, though a short burst of cold did bring demand up in early January. The bottom line is that inventories are currently at the top of the range for the last 5 years, and prices are still well below $2. So what we're looking at here is our some of our previous Henry Hub forecasts. So comparing the spring 2015 and the fall 2015 release, as well as the the gray line there is the EIA's annual energy outlook from last April. It's all kind of outdated at this point, but it's important to mention that we do use the NYMEX futures for both the Henry Hub and for our basis hub forecasts for the first 24 months of the forecast. We then blend it with our fundamental forecast for the second 24 months. Starting in year 5, the forecast is 100% fundamentals based. We use a network model of the gas transmission system, which is aggregated to pipeline corridors, and a set of annual supply curves for 59 producing areas, plus 2 active LNG terminals to determine supply. We also model storage at 33 aggregated storage hubs. Power demand is satisfied on an iterative basis between the gas and power models, and other demand sinks are treated largely exogenously. That would be LNG demand, LNG export demand, for example. In the fall, updates to our supply inputs, falling break-even costs for gas production, particularly, as well as technology improvement, and slightly lower LNG export forecasts on the demand side, as well as improving wind and solar economics that Kathy mentioned, and lower load forecasts in aggregate led to a substantial drop in the Henry Hub forecast. And we see some of the same factors playing out in the spring forecast for 2016. Moving on to view of natural gas production, it's increased 27% since 2010, from 58 Bcfd to over 74 Bcfd in 2015. Growth from shale gas is the largest driver, increasing over 25 Bcfd since 2010. This chart depicts monthly average production by shale play and overall dry gas production from the EIA. It's important to keep in mind that we're looking at dry gas production here, which is what goes on to the transmission system. Dry shale gas production has been mostly flat since peaking in April 2015, and shale gas production peaked in October, though only in December did we see a significant decline, and even then it was still just only about half a percent. We believe that with the beginning of the decline in shale gas production that we were at the very beginning of a tightening process in the markets that's likely to become more prevalent in late 2016 through 2017. The timing depends, of course, on how fast inventories are utilized, which is largely a weather-determined factor. And so why do we expect a tightening? Well, total U.S. shale wells are down, or shale rigs are down between 71 and 74% since 2014, and down 46% just since the last quarter, or since the third quarter of 2015. Overall, actually, that I should correct that. That should be the fourth quarter of 2015. Overall, gas and oil wells are down to 94. Overall gas, oil, and total wells are down 94, 386, and 480 respectively. So between 50 and 60% from average to 2015 levels. There are now no gas-directed wells operating in the Woodford and Fayetteville shales, just one in the Barnett, 2 in the Permian, and only 5 in the Eagle Ford. So as you can see here, we've really dropped off just in the last few months in terms of rigs operating and drilling for gas. Marcellus rigs are down to 30 as a number of producers have cut drilling. Chesapeake Energy, Southwestern Energy, Consol, and Anadarko Petroleum have no rigs operating in the Marcellus. Currently, Cabot and Rice Energy are down to 1 each, and Range Resources is running just 3, down from 15 at the start of 2015. So as you can see, drilling activity has been drastically reduced, and we expect that that will turn around as soon as prices turn around. Balancing the reduction in rigs, as may have heard, is the drilled but uncompleted well, or DUC well, inventory, which is large in the Marcellus, especially estimated at several thousand wells that have been drilled, again, but not completed. But a significant portion of well development costs is associated with well completion for horizontal wells. So while bringing on this production can happen at lower cost than drilling new wells, the cash still needs to be available to do so. And many of these companies are fairly cash-strapped at this point. I'm going to just breeze quickly through this slide on natural gas and oil prices. Basically, just want to highlight where the break-even cost range is compared to prices. As you can see here, we're looking at a break-even cost range for oil that's in the $45 to $80 a barrel range, but all of these prices here are converted to dollars per MMBtu, of course, and then the shale gas break-even cost range is even larger compared to you know, on a percentage basis, looking from $1 up to $5 or so, but most of that's fairly concentrated in the $3 to $4 range, we believe. So gas is being produced at this point, by and large, you know, without breaking even, at least on average. Moving on to the quick view of our snapshot of our LNG export demand forecast. This highlights from our 2015 fall forecast. We're looking at 51 projects in North America with 76 Bcfd and feed gas potential. That's at capacity, of course. Of this, we're projecting that about 16.8 Bcfd of capacity would come online, which is roughly an 80% increase beyond what's currently under construction. Most of this capacity is in the U.S., and exports are expected to produce an overall utilization rate of around 65%. However, the outlook continues to increase in uncertainty. We've got the oil-linked method for determining prices on the global scale coming under increased pressure. We would underline again that there's a strong first mover advantage on cost and contracting for the U.S. under construction projects, and all of which are fairly well contracted. Given the economic headwinds, we see additional cooling of the investment climate for British Columbia projects, with some additional attention on the potential for Eastern Canadian LNG exports. Investors, and just in a little bit of news in terms of LNG project developments, investors in the Douglas Channel project, which was slated for British Columbia, and one of the furthest along of the project queue up there, recently announced that they were halting development, and as well, just this week, FERC denied the permit for the Jordan Cove project in Oregon, primarily citing landowner concerns over the impact of the pipeline linking the project with the interstate pipeline network. So this is a setback, and FERC did raise other issues, but the project's developers did say that they would reapply. So the project not necessarily dead, but definitely a setback. Moving on to gas transmission. So what we're looking at here is a map, a rather crowded map of most of the pipeline projects in development to take gas out of the Marcellus and Utica and deliver to either the PJM footprint or beyond. We see about 15 to 16 Bcfd of additional capacity to deliver Marcellus gas beyond current capacity by 2020 if all the projects that are currently pre-filed are developed, and that's our major criteria for including projects in our pipeline database. We have added one major product to our database for the spring, the Algonquin Access Northeast project, which pre-filed in November of last year, and it's slated to provide up to 900 MMCFD of additional capacity, again, primarily aimed at the ISO New England generators, and that one's not on this map. There are just a few projects outside of the Marcellus-Utica sphere that will have that are also we also added for the fall case. That include increasing capacity in Mexico, as well as the Sooner Trails project, which is in Oklahoma and Texas, which will increase connectivity between the ANR hub in Oklahoma and the Carthage hub in Texas. So, coming back to this, these potential drivers for the natural gas forecast changes, in the near term, oversupply has really pushed the forwards down, especially in the very near term, the next few months. The forward curve gets a little steeper looking out, beyond six months or so. So the market does expect to see some recovery in gas prices. In the medium term, lower load forecasts and a modest increase in exports will have, sort of counteracting impacts on Henry Hub prices, and we see a fairly small potential impact in the medium term as well as in the long term, especially in the long term as we do see an improving market for LNG exports post-2025. And many of the projects in North America are fairly well positioned to capitalize on that. So it's sort of a mixed picture, but we do see overall a small amount of downward pressure on the price forecast for gas, but nothing like what we saw in the fall case in general. Moving on to coal, I've just got a quick couple of a few slides here, though there's some important developments. Coal prices continue to fall, and we're approaching the point where nearly all of the major U.S. coal producers are either in bankruptcy or teetering on the edge. Arch and Alpha Natural Resources both filed for Chapter 11 in 2016 and 2015, respectively. Patriot Coal also filed in 2015 for the second time in just a few years, as well as some other smaller producers. Peabody has announced just recently in the release of their 10K filing that, according to their financial auditor, there are doubts as to whether they can operate as a quote-unquote going concern. They've skipped a $71 million interest payment that was due yesterday and entered a 30-day grace period to make the payments. In addition to that, the largest privately held operator is also having trouble. So Murray Energy did a deal to purchase Chris Klein's Foresight Mining, which is really focused on the Illinois Basin, but Foresight is also entering the 30-day grace period on an interest payment of $24 million, or a little less than $24 million. Also yesterday. So definitely, and both of these companies have pretty low cash reserves. So it's not clear that they're going to escape bankruptcy at this point. In fact, it looks like a fairly good potential, especially for Peabody. So coal production cuts are the flavor of the day, or year, I guess, or several years. Down 11% in 2015 in total, with Central Appalachia continuing to see the largest declines on a percentage basis, partly as a result of the caving of the met coal market, but primarily, of course, due to sub-$2 gas. In total, the U.S. market lost 110 million tons of production last year. Our supply curve analysis shows that up to 135 million tons of 2014 production was underwater, though, at 2015 prices. So nearly half of this is in Central Appalachia. However, only 28 million tons of Central Appalachia coal came offline, indicating that there are still a lot of tons being produced under higher contracts, and probably a lot of tons to come offline. 2016, again, is likely to see another significant decline in cap and overall production, as you can see here, looking at the 2016 year-over-year changes for January plus February. We're down a total of 22%, and again, Central Appalachia leading the way down. And then lastly, just a look at where exports are. In 2015, we saw a very significant decline in thermal steam coal exports. That's the sort of medium blue line there, the 28.6 million tons. Those are in short tons. And looking at the forecasts from the IEA and some others, as well as the big banks, we do see the export forecast picture in the medium and long term coming down as well. So that will have an impact on on the prices of coal in our spring forecast in the downward direction. And with that, I will hand it back to Tom Sweet, who will wrap up for us here.
Very good. All right, thank you, Garrick. Before I get into, before I wrap up, there were a couple questions, and one was on the retirement schedule post-2016. Many of those retirements are a consequence of running the model. So for the pre-release webcast, we don't have that. However, we do consider any announced retirements from our Velocity Suite tool. That is included. But then we also include age-based retirements based on the age of the units, and then also economic retirements. So again, once the case is done, we'll have those items done. And there was another question about the application we're using for the presentation. I guess there's a couple of responses. One, for the presentation, it's WebEx, but for the actual modeling itself, the integrated model is a proprietary tool of ABB, but again, the final prices are developed using our ProMod tool. And of course, all the various inputs are driven from Velocity Suite.
Tom,
yes.
There was also a question on whether the coal prices that I showed were FOB prices, and the answer to that is yes. They're FOB prices, OTC, over-the-counter coal prices from Coal Desk LLC, which used to be a part of ICAP.
Okay. All right, thank you, Garrick. All right, quickly, I know we don't have much time, and I don't want to keep people much past the top of the hour. Our schedule. Again, we produce the reference case spring and fall. We kind of kick off the process with a pre-release webcast. And then again, May 6th, the first Friday of the month, we would release the spring results. First Friday of November, we release the fall results. We then follow that up with two different webcasts. One is for subscribers, and then a more general webcast follows that. We also have a workshop. Again, we'll definitely do New York in early June, and then both Midwest and Houston and somewhere in the West, either San Francisco or LA or San Diego or Denver. Those are still tentative, but again, we try to follow a fairly repetitive schedule. Pre-release webcast, the release of the data, subscriber webcasts, and then kind of East Coast, Eastern workshops, and then Western workshops. A little bit about the product. Again, I'll just kind of quickly go through this. Again, we're a fundamental forecast. It's a 25-year outlook. We forecast 73 market areas, and for each of those areas, of course, we have electricity prices. Since we use ProMod, we have hourly prices, but again, we summarize those results in a variety of Excel spreadsheets. We announce capacity additions, retirements, gas prices, as Garrick talked about, coal prices, as Garrick mentioned. Fundamental model, we have reserve margins, resource mix. So again, all that information is reported for each of the 73 areas. On a regional basis, we have emission prices, REC forecasts. We also do a base case and 3 scenarios. And also, finally, we update the forecast for the front 24 months on a monthly basis, where we take the latest NYMEX forecast, put that in the model to see how electric prices are impacted by the changing gas markets. Just an overview of the report, pretty much paralleling the talk today, where we're talking about the overall trends, results, and then the various drivers. I mentioned all the different spreadsheets. Generally, a lot of data here. it varies by region, but, you know, for example, for the Midwest, you know, we're looking at, you know, 12 to 15 megabytes of data. For the whole reference case, probably about 50 megabytes of data. And, you know, in the main report, we have a variety of you know, a variety of tabs with the different prices. Again, talking about, you know, what additions we're looking at, what renewables are added, retirements, load forecast, you know, gas prices, oil prices, et cetera. So a tremendous amount of results are included in the Excel spreadsheets. I want to mention kind of a new product that we have in EPM, and that is our on-demand nodal price forecast. What we found is that a lot of developers start with the reference case, but they need to get a better idea, you know, more granular than the 73 zones. So what our nodal team has done is to look at, you know, a few of the higher level zones. So we're looking at, you know, various transmission zone locations, hub prices, as well as any 345 kV and above node. So, you know, for example, with, you know, here we have PJM Mid-Atlantic. Again, we've got, you know, probably about 6 or 7 data sets in there of the nodal prices where you could get a little bit greater granularity on that. Now, with the nodal forecast, since you're looking at a full-blown, you know, transmission model, we look at a near-term 2016 and then a long-term 2020 price. So, again, a way to provide greater granularity to the reference case without having to go through a very detailed LMP analysis. I want to mention that we have a customer conference coming up May 9th through 12th in Atlanta. And again, in the package, you know, there'll be, you know, links for you to register. Again, we have early bird registration of $295. And again, you can also get a more detailed view of the agenda by clicking on the links. A couple reasons why you might want to attend. You know, biggest is that you can interact with the various customers, find out how they're using, you know, the various tools, and you know, hopefully obtain best practices. We could also, you know, talk to us, chat with us, tell us what you like, tell us what you don't like, and you know, also hear presentations about where we're taking, you know, our solutions as we move forward. We talked also about EPM. We have a variety of other services. Again, for a lot of cases, reference cases is the start of most valuation work. But in addition, we do asset valuation and any market analysis. One of the things that we do also is custom scenarios. With the fundamental model, it's relatively easy for us to make changes and see how that impacts prices. So if you want to look at a different load forecast, it's very easy to implement. We can see how that, you know, impacts fuel prices, electric prices, et cetera. I mentioned the nodal LMP work. Of course, we have the new on-demand product, but again, if you need a detailed, you know, LMP forecast, identifying curtailments, et cetera, we can drill down to that level. If you're interested in optimizing your portfolio, we have an IRP group, and then finally, if you license the ProMod model, you could obtain simulation-ready data, and you can do all of these things yourself in-house. Lastly, we have a energy market intel portal available where we post current content. So I would encourage you to, you know, bookmark this link. and you'd find a lot of information there about what we're thinking, you know, trends in the market, et cetera. You can also we also have links where you could log into the various client portals to download reference case information or get into Velocity Suite Online. Finally, if you have any questions or inquiries, you can reach out to Gina, and she'll be more than happy to answer them. Finally, I want to thank my team members and co-speakers today, Kathy Jones and Garrick Hoops, for helping me out on this presentation. And more importantly, I want to thank you for your time. If you have any questions, you know, please reach out to us. And you know, looking forward to having you attend our webcast after the results are posted in May. So thank you all.